Welcome to ETF Market Insights, the ultimate destination for Canadian DIY investors eager for the latest on ETFs and the economy. Join us every week for timely insights and actionable strategies, all brought to you by BMO ETFs and our experienced panelists. Don't forget to subscribe, and let's jump right into today's episode.
Hello and welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. And today we're going to be diving into a topic that's gaining serious momentum in the investment world, and that is infrastructure and more broadly, real assets. With inflation still a concern, fiscal stimulus on the rise, and governments around the globe really ramping up spending on everything from sort of green energy to transportation. These real assets that are tangible can add a lot of diversification to a portfolio. So we're going to break down what makes these strategies unique and how they're constructed and what to look for when adding them to a portfolio. Before we do get started, just a quick reminder that we are not providing any investment advice or recommendations. Today is all about information and education for Canadian DIY investors. Today, I'm pleased to be welcoming back to the channel Tony Dong. Tony, it's great to have you back on.
Thanks for having me again, Erin.
I know you're in your new place now. Tony's located in BC, and he's just moved out to a beautiful country home. I've been following along on LinkedIn. Looks like you're living quite the life out there, Tony.
It's very relaxing, yes. I can get a lot more work done here.
Very good. Our viewers at home, you'll know Tony from his written work. He's the lead ETF analyst for ETF Central. He also writes for many other popular publications like The Motley Fool, The Street, Benzinga, and others. And more recently, Tony's launched ETFportfolioblueprint.com, a website where he shares all of his insights. So I encourage you to check that out. But let's jump right into it, Tony. The topic of the day, real assets with a focus on infrastructure. Maybe you can kick things off and get back to basics and explain what we mean by infrastructure and real assets in the context of investing. Why do we lump these together, and why are they gaining traction right now?
Sure. So infrastructure is a very broad term that refers to physical systems and facilities that are in many ways essential to the functioning of a society or economy. So it might be things like transportation, which includes roads, railways, and airports. It can include utilities like electricity, water, natural gas, and increasingly in a modern economy, telecommunications and data centers. Infrastructure in terms of an asset class, it can be publicly traded, such as stocks that own these, or in some cases, as we see with the CPP and other pension plans or institutional investors, private assets, including private funds, private partnerships, and even direct private investments. Now, real assets is a broader term that does encompass infrastructure, but it also includes other assets like commodities, real estate, timberland, farmland, and even precious metals. What defines this broad asset class is a tangible nature and intrinsic value, which is typically based off long-term inflation, long-term interest rates, and long-term cash flows. Both of these are gaining attention now because of inflation. We've seen Trump's tariffs are leading to an uptick in U.S. inflation. The recent numbers just came in, 2.7 year-over-year increase, which is higher than what we expected. But also smart people who construct portfolios like these assets for their diversification benefits because they don't always behave like normal stocks and bonds do. And finally, long-term, there are some structural tailwinds that make infrastructure particularly attractive as an alternative asset class.
So traditionally, we had that 60-40 fixed income equity mix. We've really had to move beyond traditional fixed income and equity over the past few years. Asset allocation has evolved. Can you get a little bit more into how these real assets provide a different, I guess, return stream, if you will, relative to these more traditional fixed income and bonds or fixed income and equities?
Yeah, sure. So the good case study for this is what happened in 2022 when inflation rose. And so your typical 60-40 portfolio kind of failed under those circumstances because traditional bonds are used for deflation protection, but they're hurt by inflation because their fixed coupon payments lose purchasing power every time the price of goods and services goes up. While some equities can provide inflation protection, it's highly sector dependent. For example, growth stocks suffer under rising rates because their cost of capital increases and their future expected earnings are discounted at a much severe rate to the present. The infrastructure in particular has built-in inflation pass-through mechanisms. For example, many utility and transportation assets are governed by regulatory frameworks or long-term contracts that have what we call escalators. The revenues can increase with inflation. Even real estate investment trusts can reprice leases over time, and a lot of infrastructure that transport commodities like pipelines will reflect price changes in raw materials. Now, not all infrastructure is equally protective. Generally, we tend to see those with pricing power, and inflation linked cash flows offer better hedging characteristics. So, once again, we always go back to pipelines, and a lot of people own Enbridge, and Enbridge is one of those outperformers during those high inflation years.
Okay, so let's bring it back to a couple BMO ETF examples. Good example of an infrastructure ETF, something you've written a lot about, ZGI or BMO Global Infrastructure Index ETF, or getting more into the real assets that are with a real estate investment trusts. What kind of assets or sectors are these looking at, and what can you tell us about these?
Sure. So it's important to recognize that infrastructure is not an official GIC sector or GICS, Global Industry Classifications. It tends to be a cross-sector theme composed of utilities, energy, and sometimes industrial. So looking at ZGI in the top holdings, you'll find even real estate investment trusts like American Tower Corp, and they provide a lot of the 5G and telecommunications networks across the continental United States. You have Enbridge, of course, which is one of the biggest natural gas and crude oil pipelines in the world. You have Williams, their competitor, and also some national utilities like National Grid, TC Energy, which is a bit of a hybrid utility slash pipeline play, and of course, Crown Castle, which operates more telecommunications. So the thing to know with all these is that all of them have tangible land with mechanical services that are running through and transporting something that without that, the economy would come to a standstill, right? These are, in effect, toll booth companies, which makes them very attractive from an investment perspective, particularly when you think about how little represented they are in a broad equity portfolio.
Okay, so they have these stable cash flows. They have, long-term contracts. Is there anything else that makes it a good inflation hedge, or why are people really drawn to this during times of inflation?
The way to look at this is that it's a bit more nuanced approach to how you would typically hedge inflation. So most investors know, for instance, that the energy sector benefits from inflation because of how commodity prices play into it. But if you think about your average energy upstream company, so your explorers and producers, there's a lot of volatility and cyclicality in their earnings. It's boom or bust. And in inflation years, it can be a boom, but if deflation hits and the price of commodities goes down, they're a bust. But with these infrastructure companies, they're not actively going out there and digging up these raw inputs. They're simply sitting in the middle of the economy and transporting the inputs from upstream to the downstream cases. And they just take a fee in the middle, again, like a toll booth. Now, it doesn't matter what volumes or however that changes, because a lot of the times these contracts that they have been agreed for up to 20 years. They have built-in increases every year, and they're able to take that free cash flow and pass it back along to investors, regardless of what's happening. Now, because they are still listed, you're going to see volatility there as people buy and sell and bid the price up and down. But long term, it's more prudent to think about them as kind of a pass-through entity. And in fact, some of the ones in the US, like master limited partnerships, are structured as such in that they are designed to return a significant portion of their free cash flow back to you as the investor.
Okay, so we've seen governments around the world also ramping up spending around green energy and public works. Can you touch on this and what we're seeing and how this might help position infrastructure ETFs to benefit?
Sure, there's a bit of uncertainty right now given what the Trump administration is doing with their Big Beautiful Bill Act. But back in 2022, the U.S. Introduced a key piece of legislation called the Infrastructure Investment and Jobs Act and the Inflation Reductions Act. It essentially directed hundreds of billions of dollars into roads, bridges, renewable energy, EV charging infrastructure, and power grid modernization. And we're seeing similar things play out in Europe and parts of Asia. So this will benefit ETFs with exposures to more renewables, utilities, and constructions. But again, the problem with speculating on these trends is when the regime changes, when there's a different government in place and they have different policies, like what we've seen with the Trump administration, there is a risk that this may be reversed or delayed altogether. So that's where your volatility and your uncertainty comes from. The timeline for execution for this can be slow, and there's often a lot of political risk and regulatory complexity. Um, Long term, though, the need is there. The infrastructure has to be modernized. You read all day about, failing bridges and roads in the US and maybe even in Canada too. And another cool thing is that in the event of a recession, infrastructure spending is one of the go-to and one of the safest ways for a government to stimulate spending without potentially reigniting inflation or without running a large deficit, because this directly creates jobs and it benefits the public. It's a good way that the circular economy can work.
Yeah, we saw that with the big announcement out of Germany, I guess a couple months ago now. Um, so definitely a global theme. Are there other macroeconomic or policy trends that are driving demand for infrastructure today that you'd
Yeah, absolutely. So in particular, I like to highlight digital infrastructure and that the traditional concept of infrastructure you see that many ETFs use is heavily focused in two things, pipelines and utilities, right? So things that are moving raw energy. But you and I both know that the modern economy goes beyond just things. It also deals with data. And not only does that include telecommunications, real estate investment trusts, but also data centers. So the actual physical backbone that is providing the power and the capacity for all these applications of 5G, cloud computing, and AI. So that's driving a lot of investment in fiber optic lines and data centers and telecom towers. We're also seeing an increase in what I call friendshoring and nearshoring. So, after COVID-19 and after all the global conflicts that have popped up since, geopolitical tension is prompting a lot of countries to invest in domestic manufacturing capacity. And a lot of that requires logistical infrastructure. So instead of shipping something through the Strait of Hormuz, maybe we friendshore to Mexico and develop better rail lines, better pipelines, better shipping, better less than truckload logistics to bring that over to the US at a lower cost and without the risk of a unfriendly foreign country disrupting that. And finally, this might not directly benefit public investors, but it raises awareness for the class itself. We're seeing a lot of private capital involvement. Pension funds, sovereign wealth funds, including our very own CPP, continue to allocate capital to private infrastructure. They're not buying stocks like us of Enbridge on the public market. They have access to direct deals. For instance, the CPP might finance the opening of an airport in a different country. And then you also see a lot of big public entities like Brookfield heavily involved with their own infrastructure vehicles like Brookfield Infrastructure Partners and Brookfield Renewable Partners that are constantly doing deals and doing what we call capital recycling, buying something, overhauling it, selling it for profit and repeating. There's a lot of structural tailwinds for this asset class to be excited about.
For sure. Sounds that way. So a lot of our audience is, I would say probably traditional index focused investors. You mentioned there is no GIC sector for infrastructure, for example. Are these types of investors, traditionally, would they be underweight to these types of asset classes? And how does this really fit in a portfolio construction?
Massively. So your average broad market index fund is market capitalization weighted. So the larger a company is, or the larger its free float is, the more of an allocation you're going to see. What this works out to today, given the US dominance, is a strong overweight to three sectors: information technology, then financials, then industrials. And we see this in the MSCI World Index, where the traditional infrastructure spanning sectors of real estate, utilities, and energy are severely underweight. Energy only has a 3.5% weight. Utilities is 2.67. Real estate is 1.95. So you can make the argument that, yeah, this is what the efficient market cap weight is. That's how these asset classes have performed, and that's what they deserve. But you are very much concentrated in technology. You have 26% of your allocation technology if you just passively index world equities. And if you are concerned about inflation, just allocating to an infrastructure all-in-one solution could be an easy way to do that than cobbling it together yourself from energy, utilities, and real estate. You have the benefit of a recognizable index that is transparent. You can look closely into it and see how exactly it picks its stocks, and you get the benefits of professional rebalancing and portfolio management.
Awesome. And ETFs have obviously made this really easy, but maybe you can rewind to like 20 years ago when, it was basically just institutions investing in these types of asset classes. How would they traditionally do that? And what does that look like today for retail investors?
So if I was an institution and I wanted to buy infrastructure, I could do this in several ways. If I had a lot of money and I had the connections to make a deal, I could go directly to, say, a regional airport and say, okay, I'd like to fund your expansion. We can do this by either debt or equity. So if there's debt, I might be able to buy a revenue bond for them. I loan them a set amount of money, and then from the money they earn in the future, they pay me a percentage of that for X number of years. I can also do it via private equity. So I would directly buy a stake in the airport. I would have a say in how things are, approve who's getting selected to the board. And then later, I would have to wait for what's called a liquidity event. So maybe the airport goes public. Maybe a larger domestic investor wants to buy a slice and I sell mine to them. That's where I realize my gains. Or I might be able to use a combination of hybrid instruments. Or for instance, I might be able to extend them preferred shares. This way, I can't vote, but I'm higher in the capital structure. So if something happens, I'm more protected than common shareholders. I get a fixed coupon that is benchmarked to some reference rate, maybe, LIBOR or SOFR or something like that. So these are all the ways that institutional investors can. Retail investors can buy the common equities of these companies. Some of them have preferreds. For instance, I've met retail investors who own preferred shares from Enbridge. And if you really want to get fancy, you can own the bonds too. But none of these approaches are diversified. And then the ones that don't involve stocks, the ones that involve preferreds and bonds, you're not dealing on an exchange with the same amount of transparency and liquidity. And there's often a lot of complex provisions, like preferred shares often have call provisions. They often have rate resets and stuff, and there's different types. I think opting for an ETF that gives you a basket of 30 to 50 infrastructure companies weighted according to a transparent, sensible methodology, and it's worth paying a management fee for, in my opinion. I personally would not want to go create my own infrastructure exposure.
Okay, I think you touched on this last question I had for you, but when investors are going out and looking at the infrastructure ETFs or other real asset ETFs that are out there, what should they be looking for? What are the key metrics or considerations that matter the most, in your opinion?
Check how the underlying index, if it is index-based, defines infrastructure exposure. For instance, I've seen some infrastructure ETFs in the US where they include hospitals and schools. And yeah, you could make an argument that those are social infrastructure, but those two types of infrastructure do not possess the same inflation sensitivity, the same price pass-through, nor the same just commodity-linked upside that you would get from traditional infrastructure. So be very careful what the index entails. In addition, you need to look at geographical exposure, and this plays into how liquid your ETF might be. Remember, ETF liquidity is based on that of the underlying securities. So if you have an infrastructure ETF that only holds, say, North American listed stocks on Canadian and US exchanges, that ETF is going to be very liquid. These are all heavily traded stocks on reputable exchanges. You won't have a problem there. But if you buy an infrastructure ETF holding international stocks, say maybe a Brazilian airport or an Argentinian port or, say, a Peruvian utility, well, you might run into some liquidity issues there in that the infrastructure ETF itself might have a wide bid-ask spread. And of course, the last thing I would always advise investors is keep an eye on fees. There are more and more options debuting in infrastructure by the day, and that kind of competition creates fee compression. So I think over the long term, we'll see fees come down. And all else being equal, a lower fee means less drag on your net returns, which is always a positive. That's easy alpha.
Great. So look under the hood, make sure you know what you're owning, check out the fee, and then keep an eye on that bid-ask spread to give you an insight into liquidity. Those are great tips. Thanks, Tony. Thanks so much for joining me. That's all I have for you today. So it was always a pleasure, and I hope you'll come back and join me again soon.
Absolutely. A big fan of infrastructure, and I think this is an asset class worth keeping an eye on for the near future.
That's all for today. I hope you enjoyed today's video. And if you want to learn more about any of the solutions we discussed, please visit bmoetfs.com. And we'll see you next time. Bye for now.
Thank you for tuning in to this week's episode of ETF Market Insights. Don't forget to hit that subscribe button and sign up for alerts so you never miss our latest content. For more insights and to keep the conversation going, visit us at etfmarketinsights.com. Join our mailing list and explore a wealth of resources and tools designed just for ETF investors. Until next time, stay informed and empowered in your investing journey. This session is for informational purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investment and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to your unique circumstances.